Okay, welcome back to the show. Guys, this is the part of the segment where you actually get to put stuff to use. Now, I'm here with our Chief Investment Strategist, Pat Comer, and we're gonna be going through a lot of cool things with you right now. So this is the part where you wanna pay attention because I actually got my smart guy in the room, right? So let's talk to him right now. Pat, let's tell everybody about what we were expecting last week, which happened this past week, just now actually, about earnings. Let's talk about the earnings.
Yeah, let's start with earnings first. Earnings, there were some big earnings reports last week from major tech companies, and they all just knocked it out of the park. Google, Apple, you just had great things, Amazon, and it showed in the NASDAQ. The NASDAQ pushed up towards that 52-week high. Didn't quite take it out. That would be an important, that's the next important inflection level for it. But it's all systems go right now with tech. It's a very powerful move, and the earnings are just starting to show some very good life. We're also starting to see a little bit of recovery in the balance sheets of energy stocks and banking stocks. These are very damaged sectors, so there's a lot more rebuilding to go in those. And we're keeping an eye on it. And as our viewers know, we're actually in some of these stocks. Bank of America, Huntington Bank, we like WPX, and Loretto Petroleum, which is LPI. We've spoke about these in past shows. But that's the gist of earnings. It's had a lot more life than I think people thought that it would, and it showed in the NASDAQ index, the tech index.
Yep, good. So earnings has been a big play, and it obviously directly relates to what's inside your portfolio and how you should be acting, and really what you should be looking at moving forward. Now, next we want to talk about the Fed meeting. So why don't we do this? Why don't we just take a quick little break? Let's pull up our slides for everybody, and then we'll get into the Fed meeting right after this. Stick around. Okay, we are back. Thank you for coming back. Now, I think it was last Tuesday and last Wednesday, the Fed had a meeting, and it was a big deal. And it was a big deal to all of us that have money in the stock market, investors, and anyone. Maybe if you don't have money in the stock market, maybe it's just money that's sitting in the bank, and what it really means to you. Mm-hmm. So let's tell them about that Fed meeting and what it means to their portfolio. Well,
the Fed meetings are getting a lot more interesting because we're getting to the point where it's really a rubber meets the road situation for the Fed, for Janet Yellen. What's happening is you're at the point where we've put some distance between us and QE. And now it's an interest rate situation where when are we going to hike those rates and start normalizing policy? There were some good things that happened with the economy. There were still some things that the Fed are waiting for. But their language in their statement was totally different than it's been the last couple of times. We still are along the lines that we believe we'll have a Fed rate hike before, probably in December. Yeah, there's a small possibility of September, but most likely December. And the reasons being are, Samuel, is if you look at the way the languaging of the Fed meeting, they're looking for, really what they're looking for right now is inflation, and we should see some of that starting to creep up. Oil prices have risen fairly well, and these things will just kick back into it and create a little bit of inflation. The labor, we're pretty much at full labor right now. So the labor reports are still having an influence on them, but not as much as they were before. The unemployment rate and things like that. So there's just a lot of things. We'll talk about the GDP release on Friday a little later in the show, but there's some things in the GDP release that we saw that also lead us to believe that there'll be a Fed rate hike sometime before the end of the year.
Okay, so I mean, our listeners are probably wondering what that really means. Look, you got money tied up in the stock market. What does that, the Fed meeting, really have to do with our money that's wherever it is?
Well, the market's really addicted right now to the Fed easing and the Fed money pumping. So initially, people's reaction is adverse. People love the free money, the freewheeling bull market that just never seems to run out of steam. But the reality of it is at some point the economy has to be healthy enough to absorb a rate hike. And that is a positive sign. If we are prepared for a rate hike and it's done properly, which I think the Fed is on track to handle this properly. It's a good thing. It'll help banking sectors. It'll help all the financial sectors. There's a lot of sectors that'll be helped by this that have been hurt over the last 7 or 8 years.
Yep.
So you'll see a lot of opportunity to grab stocks that are at bottom.
Right. So these are some of the things that we look at when we look at our portfolios and things we want to invest in on a weekly basis. Right. You know, you just don't want to buy Tesla stock because you like the Tesla car, right? That's crazy thinking. Yeah. Unless there's some real statistics backing up why you want to invest in something like that. So, this is a good example of why we invest in the things we do.
It's interesting that you mentioned that because, the way our parents and their parents invested were, if you see everybody using Tide, you bought P&J, right? Because everybody's buying Tide, so their sales must be good. But it's different now. Like you said with a Tesla, just because it's a great car, just because it's something that you think people would like, that's not a reason to buy the stock anymore. Right. You have to find catalyst for growth, and that involves research, and that involves a lot of anticipation.
There's probably a lot of you out there that were in that situation. In fact, this is how I used to be when I used to invest in the stock market, starting when I was like 15. I mean, I remember buying stock just because I had no clue, much like probably some of you. It's like, I bought stock, I maybe it was AT&T or something, some major company, just because I was like, oh, it's a good company. I'll make a ton of money. Absolutely. Because it's a great company. And the truth is, man, I was so stupid. Now, depending on what I was looking to do, what you're looking to do in your stock market portfolio, maybe you just want, tax write-off. Maybe you want small incremental growth for 45 years down the road. Who knows? Maybe you just want, I don't know. The point is that when I was that young, I just was buying stock in a company because I thought it was a good company. Now, there's so many things that you need to pay attention to, and this is actually what we do here with our investment team, right? Pat runs a team here at Financial Reboot that actually they review all these things, the Fed, the earnings reports, all these things that directly affect the stock market, and the prices, Absolutely. And S&P 500, and all this stuff that you probably have no idea about. I sure didn't when I first started. So these are all really important things to talk about now.
Because just quickly as a real world example, recently a lot of people made that mistake with Nintendo.
Oh yeah,
with
right.
Pokemon Go.
Pokemon, right.
That stock shot up, and now it's just kind of crumbling down. Yeah. There has to be earnings. There has to be something besides just some wide sensationalism of a bunch of kids playing it.
So listen, let's do this. You guys need a quick break because that was a lot for the brain to handle. So we're going to get right back into the Bank of Japan. Domo arigato. Now, Bank of Japan is going to have we've got some really cool things to talk about. So let's take a quick little bumper. I'm going to fill up my coffee and we'll get right back. Okay, now that we got a fresh cup of beverage, which I needed so badly. I mean, these lights are brutal. It's so hot in here. Now we're going to talk about the Bank of Japan. Bank of Japan. Now, Pat, tell everybody why this is important to our viewers out there. Bank of Japan.
Well, the Bank of Japan, their policy affects currency, and a big one is gold. Gold was a little disappointed with the Bank of Japan this week. They decided not to lower their negative interest rates anymore. They did decide on a big stimulus, buying ETFs. But there was a lot of disappointment in that from the gold traders.
Yep. And so were there rates involved in that? Was there a change to the rates?
They decided to hold steady on their rate,
right? So,
which surprised a lot of people.
Okay. And was there another round of stimulus for that?
There's a massive round of stimulus that they're putting into it. And it's mostly buying ETFs within the Japanese market.
And how does that relate to the yen? The Japanese yen?
Well, the interest rates, of course, affect the yen. The yen struggled against the dollar. The dollar blew up a little bit, and that hurts gold. That puts a little headwinds for gold.
Now, I know it sounds like I know what the hell I'm talking about, but the truth is I don't. We just teed up these questions for our smart guy to answer. In case you need answers to these smart questions, I, on the other hand, just want to know what I need to be invested in to make money in the market, and that's most important. That's why our investment team does such a great job for us. and we have here, hasn't pushed gold high enough. What does that mean related to the Bank of Japan?
Gold had a little bit of a retrace the week before, and it did pop gold. It had a $15 move one day. I think it had a $12 move the day before that. But it did not break out of any resistance. It's still in that little channel there between 1325 and 1375.
Okay, cool. And so how does Bank of Japan, why do they care about Bank of Japan?
Well, because it affects currency, it affects gold, and that affects your markets.
Right. I mean,
it's all intertwined.
Yeah. Thank you for that last part. Are you starting to understand how all of these, the smart guy conversation that Pat is having with everybody, are you starting to understand why this is important and how it really fits together in your investment strategy and your investment goals on what you want to participate in? Because, like we just said in that last segment, it's not about just buying your favorite company and hoping you make $1 million from it. It's about having specified knowledge in the markets, because everything is related to each other. Much like the FANG stocks are 43% of the...
They're about 40 to 43% of the bull market.
Right. So, guys, this is why I've got an investment team of smart people around, because I'm just a dummy. What do I know? The point is, I'm smart enough to assemble guys like Pat and the entire team that really go through, find the picks for me and our clients, and make our suggestions on what we would do if they were in our portfolio. Right.
Absolutely.
That's kind of our model here. So we got a big one coming up after the break. In fact, you know what? Let's take a quick break and let's get the slides prepared for everybody.
Absolutely.
And we'll do that right now. We'll take a quick break and we'll come back with the GDP. Okay, so last week, Friday, I believe, there was an announcement on the GDP.
Yes, sir.
And the report obviously plays into how people are invested in the market. Everything relates, as we talked about in one of the last segments, and things kind of intertwine in the market. So why don't you tell the viewers about the GDP and what happened?
Well, the GDP number was released, and a lot of people saw it as a disappointment. The expectations were at 2.5%. We came in a little bit above 1%. But there were some good signs internally that lead us to believe that in the third quarter we'll have a little bit of a recovery.
Okay.
So, and those signs were there was inventory reductions combined with strong consumption. What that means is these companies or these businesses that have built up big inventory supplies are finally moving these inventories off the shelf, which creates, of course, more production, because production, you have to replace inventories, creates sales, and the consumption was very good. So as long as the consumption is strong, we should see a nice third quarter.
And consumption meaning that when things circulate in the marketplace,
Absolutely.
right? And that's the whole point. That's the whole point. So guys, remember, this all interrelates. The Bank of Japan, the Fed announcement, the rate hike, all this stuff is really important to your wealth and your stock holdings, because one thing goes up, it might affect something else. So this is why we talk smart guy stuff with our investment team, because a lot of you out there have questions on, how does this really relate? What does it really mean to me? And this is why Patrick here is explaining these things to you. So pay attention if it means something to you, because it does make a difference. Now, we are going to, my phone has been going crazy. And so we are going to get into the question and answers, because if you've been paying attention, you can text your questions to us at 760-254-0003. Text the word show to that number, 760-254-0003. Text the word show, and you can ask your questions directly to us here on the set. And what we'll do is we'll take a quick break, and we'll let those questions come rolling in, and then we will come right back and answer them for you. Ta-da, like magic. We'll be right back.